Have you guys ever wondered what is actually happening in the markets? When to actually be very aggressive or when to be defensive? The market doesn't just dump on some random news. It does give you signal and hints that you can actually pick up to actually position yourself in a much favorable spot. I'm going to show you the one simple tool that I use every single day to prevent me from buying at the very top or selling at the very bottom. So by the end of this video, you can actually apply this into your trading system regardless you're a day trader, swing trader, or position trader. Because understanding the market in a higher time frame is what every trader should actually do. So without further ado, let's jump right in.
So if you're still struggling to find consistency in the market, you're probably thinking that it's because of your trading system or your trading strategy that has an issue. But there's actually a very high probability that it's neither both of them. You see, a lot of traders actually forget the fact that they need market context in order to trade better in the market. So imagine you trying to ride a boat towards an island and you riding against the tides, the waves, or even the winds. There's actually a very high chance that you're not going to be efficient, no matter how great of a sailor you are. So the same concept actually applies in trading. You want to trade with the big trends and where the institutional boys are actually trading too. So if the entire market is actually on an uptrend, you only want to trade longs. And that goes the same thing with shorts as well. If the market is dumping, then you only want to take short positions. Have you guys realized that some months are actually harder to trade compared to the other? For example, in January 2025, I've lost 22,000 trading my breakout strategy. As compared to in July, I've managed to make 140,000 by using the same exact strategy. So what really changed? I'm using the exact strategy without changing anything, but I have two very, very different results, which is a pretty drastic difference. So the main reason for both of this is actually market context. So by the end of this video, you actually understand the one simple way I use to read market sentiment. How do I actually avoid choppy markets like the one I just showed you in January? And then I'll show you real examples on high probability conditions that you can take advantage of and be really aggressive to make a lot of money. And then you will have actionable steps that you can take that can apply immediately into your trading system to increase your win rate. So the simplest tool to actually read market sentiment is actually VIX. So what we're going to do is that we're going to break VIX down into three segments. I'm going to explain to you what is VIX and why is VIX important. How can we actually use VIX to our advantage and improve our trading system? And then I'm going to give you real trade examples and show you how to actually apply them in real scenarios. So let's start off with the definition of VIX, all right? So what is actually VIX? The simple definition of VIX is basically the volatility index. And what VIX measures is actually the fear in the stock market. So if there's a lot of fear in the stock market, the VIX will actually be high. And vice versa, if the market is actually trending higher, it simply means that a lot of investors are confident in the market. If you want to know the technical definition, VIX actually measures SPY's put and call option for the next 23 to 37 days. So what it basically means is that a lot of investors are actually buying put or call options very far out of the money for the next 30 days. It means that a lot of investors are expecting a lot of volatility on the market itself. So in simpler terms, if the VIX is on the high side, a lot of investors are actually on the fearful side and they are very wary and cautious of what the market is going to do for the next 30 days. So secondly, we want to understand why is VIX important to us. I've just put up two charts side by side. On the left side, we have the SPY, which is also the market. And on the right side, we have the VIX chart, which is the fear index. So if you notice that there's actually a very close correlation between these two charts. Whenever the SPY drops in price, the VIX actually will increase. And whenever SPY actually increase, the VIX will actually decrease. If the SPY, which also known as the market, is actually rising, it simply means that a lot of investors are actually very confident in the market. And that also implies that they are not actually fearful. That's why VIX is actually dropping. So in a healthy market, when the market is trending, both of them are actually inverse. SPY will actually increase and VIX will actually decrease. That's how it normally works. So now we understand the importance of VIX. Let's talk about how can we actually use VIX into our trading system. So we want to see the four different correlations between SPY and VIX. You can see if SPY is increasing while VIX is decreasing, it simply implies that the fear is actually very low in the market and market is always trending higher. So this is a very good and optimal condition for you to trade. You see, if you want to buy a stock, we want a stock to always trade higher and we want it to make money for us. So if you want to enter a long position, we always want to have this optimal condition where SPY is actually increasing while VIX is decreasing, because that simply implies that the market is probably in a very healthy uptrend and there's a very high probability that our trade is going to play out. So for the second market condition, you can see that the SPY is actually decreasing while VIX is actually increasing. And what that simply implies is that the fear is actually very high in the market and the selling pressure is really strong because there's a lot of volatility in the market as well. So you want to reduce your trading size and be really cautious because the trend has already proven to be weakened. So if you're taking any long positions, I'll be very cautious as well. But on the other hand, if you're taking short position, this market condition is actually optimal for you. And there's actually a very high chance for it to play out because you're actually trading along with the trend, which is on the downtrend. And for the third market condition, you can see that SPY is actually increasing and VIX is increasing as well. So this is what we call a bearish divergence. So what it simply means is that the market is actually going up, but the fear is also rising. So the rally that you see in the market may be weak or fake. So we just talked about a technical definition of VIX, where a lot of investors are actually buying put or call options, which cause VIX to increase in price. So from a technical perspective, a lot of investors may be buying hedge positions. So they buy a lot of put options to hedge against their long positions that cause the VIX to rise up. It may be a signal for pullback, reversals, or corrections. So in this kind of scenarios, we always want to avoid aggressive longs and we always want to reduce in size. And for the fourth scenario, you can see that SPY is actually decreasing and VIX is decreasing as well. This is what we call a bullish divergence. So the market is actually dropping, but the fear is not increasing. This may imply that the selling pressure is actually weak. So in scenarios like this, a lot of times investors will look at this as a potential dip buying signal because the risk is actually lower than it looks. By just understanding the context of SPY and VIX, you can already put in a story of the entire market context of what is actually happening in the market right now. And what you want to do as a trader is to always put yourself in a favorable position where you're always trading alongside the big boys and the big trends as well. In that way, you can significantly improve your win rate. So if you can see my trading results that I've shared with you on January where I lost a lot of money, the market condition is actually the second market condition where SPY is actually decreasing while VIX is increasing as well. So you can just pop into your trading view and have a look. Then you probably understand that I'm actually taking a lot of long positions in this second market condition, which made me lost $22,000. But in July, the market condition is actually the first market condition where SPY is actually increasing and VIX is actually decreasing. So it simply means that in July itself is a very healthy uptrend and I'm taking a lot of long positions as well. That's why I've managed to make $140,000. So I want to give you a simple analogy for you to take home, all right? So imagine you're driving on a highway. It's much easier to drive in a sunny condition because the floor is dry and the vision is clear. As compared if you're driving in a thunderstorm, the floor is very slippery and the vision is very blurry. It's always easier to trade if the VIX is actually low because we always want to take long positions in the bullish market. And our win rate will actually increase drastically if the VIX is actually low. You can see that I'm actually on my trading view. I'm going to show you the two charts that I've pulled up, all right? So VIX is actually on the right side. You can see right here. And on the left side, we actually have our stock of interest. So before we actually go into the real trade example, I'm just going to talk about VIX a little bit. So I've actually put up 4 segments. You can see that the trending zone, the caution zone, the fearful zone, and the panic zone. So the reason I put up these 4 segments is actually to give me a very clear visual representation of what the market is actually doing. So if the VIX price is actually trading between 13 to 18, I call that my trending zone. So I can be very aggressive in terms of long positions in the trending zone. So if VIX is trading between 18 to 23, I call that the caution zone where I want to be really cautious in terms of taking aggressive longs. And if VIX is trading between 23 to 30, I call that the fearful zone where the market is actually in a very fearful state. So in zones like this, it's more favorable to take short positions than long positions. And if the VIX is trading above 30, that is what I call the panic zone where the market is dumping aggressively and everyone is actually in a panic mode. So with these 4 segments in mind, it gives us a very clear market context of what is actually happening. So let's jump back to our real trade examples, all right? So the stock I'm looking right now is actually IONQ, which is one of the trades I've taken on the 9th of September, as you can see. So on the 9th of September, you can see that IONQ actually broke our trend line and actually alerted us that this may be a potential setup. So if you look at the VIX, at this point of time, the VIX is actually in the trending zone, which is trading around $15. And this simply means that we're actually trading along with the trend. And there's actually a very high probability of this trade actually playing out. So I want to take a long position risking $2,500 in order to make more than $5,000, which is minimum of 2R. And let's see how the trade plays out. So you can see that IONQ hit our TP in a matter of 1 week. It's still aggressively moving up. And one of the reasons for that is mainly because we are trading alongside the trend. And if you're trading a momentum breakout system like I do, it's very important to trade the trend because the trend actually gives you a lot of follow through. So the second example I'll give you is actually RVMD. So you can see that RVMD, I've taken a long position on the 29th of September because price actually broke out from my trend line. And if I look at the breakout candle, I can see that VIX is actually trading below 18, which is also the trending zone. So what that simply means is that the market is still trending. There's actually a very high chance for this trade to play out. So let's see what happens. I'm risking $2,500 in order to make a minimum of $5,000, which is a minimum of 1 to 2 risk to reward. So you can see that for this trade RVMD, once we've taken a long positions, we were never in a drawdown. The trade went to our favor right away, even though it chopped for a little bit, eventually hitting our take profit as well. And that goes to show you that if you're always trading alongside the trend, there's actually a very high chance for your system to actually play out. And these work extremely well for my breakout system. So the third example I'm going to show you is actually Intel. You can see that Intel is actually trading above the EMA 20 and is retracing back down, eventually broke out from our trend line. So in my trading system, this is actually an A+ setup. I took a long position on the 17th of October and I called this out live on my Instagram and Telegram as well. So many of my members actually took this trade with me. However, I did not take market context into consideration when I'm taking this trade. So you can see at the point of this breakout candle, the VIX is actually trading at the fearful zone at above $23. So what it simply means is that the market is actually very fearful and there might be a possible pullback at this point of time. So I took a buy position risking $5,000 in order to make $10,000 and let's see how that plays out. You see, in a matter of 5 days, we eventually got chopped out of our position, resulting in a loss of $2,500. So one of the reasons for that is also because we did not take market context into consideration. If the market is actually very fearful, it's actually what we call a very low probability scenario and trading environment for us to actually take any long positions. And that is also why it's not smart to actually take any long positions when the market is actually very fearful. So guys, the point I'm trying to make in this video is that I want you to understand that putting market context into your trading system can actually drastically improve your win rate and your risk to reward as well. And the point is not to actually avoid losses because I want to be as transparent as possible and show you all my wins and losses as well. We understand that losses are part of the game, but what we want to do as traders is to always put ourselves in a very favorable position and trading environment so that the probability of us actually turn out profitable is actually much higher. So what I want you to do is actually apply this concept into your trading system so you have a better understanding of what is actually happening in the markets. So if you like this kind of video, please subscribe to the channel, turn on the notification bell, like, comment down below, and I'll see you in the next video. Cheers, guys.